Welcome to The Trade. Before we get into the technicals, let's see what traders are watching. And the bombing campaign against Iran continues while it has launched a wave of missiles at Israel and also vowed to retaliate against Americans with a US submarine torpedoing an Iranian frigate. More tankers also coming under attack in Gulf waters, and Iranian drones entered into Azerbaijan to its north, prompting concern that war could drag in other oil-producing states. Drone attacks also targeting an Iranian opposition camp in Iraqi Kurdistan, as well as an oil field operated by an American firm. Meanwhile, President Trump has claimed the right to decide Iran's next leader. And in the latest US economic data, Q4 productivity beat forecast, growing almost 3%, weekly jobless claims steady. US Treasury yields continuing their ascent. And we also saw the 2-year rise to a 1-month high. The Aussie 3-year government bond yield rose to 4.42%, the 10-year at 4.86%. And having a look at where currencies sit this morning, the Aussie is a little stronger against the greenback at 70.2 US cents. To get across the technicals, Andrew joined Richard Wiseman from Wiseman Consulting, starting at looking at momentum in the Brent crude oil market.
This is a market that for right now wants to go higher, and I figured we'd pull up the Brent crude since it's the global marker, and the level that I'm looking at is that unfilled gap. So the Sunday night open, we tried to fill that gap and we couldn't do it. So that level is $75.75 a barrel, basis the May Brent crude oil futures. And if we don't fill it, which so far we haven't, even though we've tried, then odds favor a move to the upside to continue. And that's what we've seen day after day. Other markets have backed and filled, and Brent has not done that, which suggests that there's an imbalance in terms of supply demand. There's a fear premium in this market, and potentially if things get worse in terms of disruption of the supply moving through the Straits of Hormuz, I potentially could see this thing going to $100 a barrel.
Richard, technically, just explain to us what an unfilled gap is.
Yeah, so basically what happened was we had the war start over the weekend. So what that did was it created buying pressure, and we didn't open at the price that we closed on Friday. Instead, we opened higher than that price, and that reflects the new supply-demand equilibrium, which is north of $75.75 a barrel. And if we do go down and test that 75.75, then maybe all bets are over and we start a new bear leg. But if we don't, it could go a lot higher.
All right, so you're saying potentially $100 plus. Such a dynamic move there. We'll keep our eyes on that. Now, Richard, of course, in the energy space, it's not just oil that's been affected, it's also natural gas, given particularly in the Strait of Hormuz, so much of the world's supply, again, transits that choke point as such. So what are you seeing with natural gas at the moment?
Yeah, so I follow the North American marker, which there's a huge export market. And I think that's what we've been seeing this week, is that we were in oversupplied territory. North American natural gas, the marker is Henry Hub, Sabine, Louisiana. We were kind of destined to go lower and retest that $2.60 per MMBtu in natural gas. And then we had that weekend event. So obviously it's much less dramatic. We have a lot of supply in North America, And the more barrels of oil we bring to market, the more supply of associated gas comes to market. Nevertheless, that minor uptrend that you see, we are starting to catch a bid and become a little bit more pricey in terms of North American natural gas. So first thing we need to do, we need to break that downtrend line, which comes in at around $3.20 per MMBtu. If we do that, if things tighten up in terms of supply and there's more demand globally for LNG, then Henry Hub is going to be impacted by that. We're going to take out that 320 and potentially go all the way up to $4 per MMBtu.
All right, those are the key levels to watch out for when talking gas. Now, Richard, given what we're seeing in the energy market at the moment, it's very much dictating what we're seeing with risk assets, most notably, obviously, with equities. And in the session just gone, obviously some very heavy selling there. This is based on the fact that the prospects there of the inflationary impacts of a rising oil price, and perhaps that those interest rate cuts are not going to materialise. What are you seeing then for the S&P?
Yeah, so it's a different story. This is still a bull market. There's no question about it. But you can see that we are range bound. We've been range bound, actually, I would argue, since November. We have tried to take out 7,000, and every time we give it a shot, sellers come in. And now the question is, do we take out that support? It comes in at around 6,600. We didn't take it out today. Buyers are coming in at this point. It's still a kind of buy the dip, sell the rally type of market. All things being equal, these consolidation areas tend to resolve themselves in the direction of the preceding trend, which was up. So it's still a somewhat bullish picture, even though we're seeing real selling come into this market. If we do take out that 6,600, then all bets are off. And I would say there's good psychological support coming in at around 6,000.
All right, so you're saying the odds in favour of a bullish break. Nonetheless,
Still.
I mean, there are many market commentators who say we are overdue for a correction. What would you be looking for? Is that 66 level?
So 66 is the line in the sand. We take that out. Maybe we go to 6,000. I still think that it would just be a correction and not the beginning of a major bear market. It's possible to get an inflation-driven, geopolitical driven trend change and the beginning of a prolonged bear trend. That's possible, but the odds favor just a correction. Maybe 6,600 is the first obvious point for us to retest. If we break it, maybe 6,000. But at this point, I would say it's very difficult for a geopolitical risk to turn into a new bear trend. Not impossible. It happened in the 70s, but it is not the most likely scenario at this point.
All right, Richard Wiseman there from Wiseman Consulting. Speaking to Andrew a little earlier, that does it for this edition of The Trade. Be sure to join us again next week.